Assalamu alaikum, Mazin.
Walaikum salam, doctor. How are you?
Fine.
Alhamdulillah.
When commonly we have did so many times in the additional information, they will give taxation. Whatever the additional information they taxation, this taxation is for the current year. I will give a brief overview about what are the things we'll come across in this chapter. Sometimes there will be a credit balance will be there in the trial balance. Is it? It means we have over provision is there. Sometimes there will not be a debit balance. Okay, debit balance means you have not paid the tax. That never happens. Usually not happens. We have to take, if you take Oman into consideration, we have to pay the tax within the next 30 days. Okay, after the period end, if you are for 3 months, if you are paying for the VAT, take example of VAT, is it? Next third of completion of 3 months, you have to pay within next 30 days. Okay, you have to file the returns. But what will happen? This is a normal practice. Okay, this is a normal practice. In some cases, that tax will be paid when it happened. Is that the issue is it happens. You are in the year 2024, but you will not the tax which you are going to pay will be related to 2025 and will be related to 2026. This is not related to 20. Then why you will pay in 2024? You will not pay in 2024. You will keep it noted and you will pay in 2025. This type of taxation is called as a deferred taxation. You are deferring the tax with respect to the specific period during which you are going to pay. That much is there, is it? Means you should know in which year you have to pay, and that year you have to take it into account. Accounting for current taxation in accordance with IAS 12. IAS 12 talks about income taxes, International Accounting Standard. The effect of the taxable and deductible temporary difference. It will take little time to understand this. First time we are going to come across this. Okay, temporary difference. See what happens usually you have to pay tax by 31st December reporting date. Okay, definitely we are going to do what? We are making a provision for taxation. Okay, we are going to have a provision for taxation. Whenever there is a provision for taxation, the provision is nothing but we are making an estimates. Okay, sometimes the estimates will be positive, sometimes you will have a shortage of estimates. When there is a positive or minus, in that case, in that extreme cases, you will come across something called as temporary difference. Is that you will come across temporary difference as such. Okay, how we have to treat that temporary difference? Compute and record deferred tax amounts. I told you deferred tax amount is nothing but tax which is going to be prepaid off in a later period. Is right? We are only computing and we are recording. Okay, any deferred tax amounts in the financial statements. Fine, this is these are the three basic points we are doing. In that, what are the most important points? The most important point is deductible temporary difference. Okay, deductible temporary difference and deferred tax amounts. Okay, if you have, once you get the clear idea, automatically things will be very specific. Okay, now here I will be very slow when you are doing. What we are doing, we are talking about income tax, we are talking about accounting entries, we are talking about the specific scenarios. Deferred tax, accounting profit, taxable profits, any deferred tax liabilities or any deferred tax assets. Okay, any deferred tax assets or any deferred. One side we are talking about the income taxes, one side we are talking, on the other side we talk about the deferred taxes. Now, when we say this, anywhere, any doubt, just you stop me, okay? Just to, if you don't understand little bit, first time you are doing this. Income tax states that there are two elements of tax need to be recognized. What is the current tax and what is the deferred tax? Concept has to be clear in the first point of understanding. The amount tax payable or recoverable in the taxable profit or loss for the period. Is that what is the profit and what is the current we have to pay, what the current tax on the current profit. It is an accounting adjustment to match the effects of transactions in the relevant accounting period. Is that relevant accounting period means not in the current period, in the next 2025, 2026. Is a relevant accounting period. If it is relevant, why we will pay tax of 2025 now? We will not pay. We will pay tax related to 2025 depending on such a situation, depending on how it is going to be arised, and subsequently we will give the accounting treatment. Is it current tax for the current year, deferred tax for the relevant accounting period. The figure for current tax profits is an estimate amount that will be eventually paid, is it right, or received, and will appear where we appear in the current liabilities or assets in the financial position. What is the general entry we have to write? Is a tax is an expense, debit tax expenses, credit is a payable, because it's a liability, is it right? It is a liability, and most important, it is a liability which is going to be paid in the next 12 months, okay, next 12 months after reporting date. This is very important. Is it? What is the current liability? Next 12 months after the reporting date. 31st December this year, immediately next 12 months. Now, therefore, the balance in the financial statements for taxation is will only be a current year. This is what we have done till now throughout all the questions. Okay? Throughout all the questions as well. Now, definitely in this process there will be under provision or there will be over provision. Is that we are making an estimates? Is that we are making an estimates? They will be plus or they will be minus. This does not affect the year-end tax liability. At the end of that year, we will make reconciliation. Is that we will do reconciliation and we will settle down if there is under provision, we will provide the additional amount. If it is over provision, we will provide see the thing. They will say, I will give you, they will say that in the trial balance, they will say taxation, is right? They will say it is the credit balance. Taxation credit balance is 2000. In the additional information, is it right? In the additional information, what they will say, the current year tax is going to be 16,200. Is it right? Now, what will happen in the profit and loss account and in the financial statements? In the profit and loss account, what we'll do, 16,200 is the current year tax. Is it? Is the current year. Already there is a credit balance is there. How much is there? Over provision is there. Is that there is over provision? Means from the profit and loss account, how much we are showing 14,200, whereas in the financial statements, in the current liabilities, we are going to show how much? 16,200. Is it? We are going to show 16,000. This is the amount which you are going to pay. This is the amount which we are going to account it, because already we have a excess provision of 2,000 in the balance sheet. That provision we will be taken into consideration with respect to the current year balance. Is it? There is a under provision. If it is under provision, increases the charge. If you have provided lesser provision, definitely you have to pay the difference. If there is a over, you have created an over provision, it will decrease the charge. Is that? If you have taken an over provision, definitely we will take the difference and do. Note that any under provision within the exam question will be simply the balance for income tax on the trial balance. Any under or over provision, exam question will simply the balance with respect to the income tax. The taxation account will only have two entries in the year: balance brought forward and payment. Is that? If the balance is the same as balance brought forward, this is where we are talking about how it is going to be accounted. Is that? A debit balance represents under provision, a credit balance represents over provision. Is that? A debit balance under. This is what I have made. I have given the example of what? I have given the example of a credit balance. Is that? Over provision. Fine. Now, Simple has estimated tax liability is how much? 180. In the previous year, they have estimated tax liability of 150. Is that? The current year tax liability is how much? 180. Previous year tax liability is how much? 150. Calculate the expenses that will be shown in the profit and loss account if the amount actually agreed and paid in respect of 2007. Is it? In the previous year, if you take the previous year, it is 2007. Is it right? 2007 we have estimated 150. Is it? 2007 we have estimated 170. Is it? Calculate the tax expenses will be shown in the statement of profit and loss account for the year ended 31st December 2008. Is it? Now, this is what they mentioned. 1 minute. Year end estimate is how much? Estimated how much? 180,000. Is it right? Last year they estimated 150,000, 165 and 140. Year end estimated 2008 is how much? 150. Under last year they have estimated how much? See, they have estimated. Is it? This is the amount they have paid. Is it right? This is the amount they have. In the end, they have paid how much? They have paid 165. They have estimated 150 and they have paid how much? 165. Is it? This is the estimated amount. This is the paid amount. Estimated amount is less, paid amount is more, means they have made a under provision. Is that? They have made a under provision. Here, they have made, last year they have made a under provision of how much? 15,000. Now they will add that 15,000, and what is the income tax expenses? Income tax expense 195. Understand this, then you will get back to me. This year estimated is 180,000. Last year we have underestimated. Is it right? We have estimated 150, but we have paid more. Is it right? We have paid more. That under provision we have to reconciling this year with 15,000. This year how much you are showing? An expense of 195. Whereas over provision, last year, this year how much we are estimating? 180,000. Is it right? We have we have estimated 150, but how much we have paid? We have paid 140.
140.
Is it? We have estimated 150, but we have paid 140. Go back to that. Yes. How much you have paid? 140. We have estimated how much? 150. This is the estimated amount, and this is the paid amount. Okay. We have estimated 150, but we paid 140. We have made a over provision. This much we have to deduct, and this is the income tax expenses. Is it clear to you? First, see the solution. Is it okay?
Can you explain?
Pardon?
Can you explain?
See the thing. Okay? Wow, okay. I will put it in a team form. How much we have estimated? We have estimated how much? 180. Okay, we have estimated. This is the current year. Okay, this is the current year. Last year we have estimated less. Is it right? We have estimated less. How much we have estimated less? We have estimated less of how much? This is the
50.
last year. Is it? This is the last year. How much we have paid? We have paid how much? We have paid 165. Is that we have paid how much? We have paid 165. How much is the difference? You see 180 plus 150 minus 165. Is that 180?
Yeah.
180 plus 150 minus
165.
1 minute. 180 is the current year. 150 is the last year. How much we have paid now?
It is saying doctor agreed to pay. It's not seems like they paid.
Yeah.
Agreed to pay.
This is the provision last year. Okay. No. No. 1 minute. 1 minute. Agreed and paid. Actually agreed and paid.
Okay. Yeah.
Actually
Yeah.
agreed and paid to the tax authority. See the thing? How much we have made a provision? We have combined both the things. That is the reason we. How much we have made the provision? We have made the provision of 150, but we have paid how much? We have paid 165. How much we have to pay? You have to do additional provision. We have to do an additional provision of how much? We have to do an additional provision of 15,000. This is the last year. Is it that this is the last year? Current year.
What?
Tell me.
Why they paid more?
Because provision.
No, they're supposed to pay 150. So they paid more 165.
No, they make provision for 150. And they pay 165.
They have paid to the tax authority in respect of 2007.
Yeah.
Is that I will write here only? Okay, I will write here only.
But
I will not take next step. 2007. Okay, 2007. Estimated how much? 150. Is that this is the estimated amount? Okay, this is the estimate. How much they have paid? See, estimated is a
165.
liability payable. Estimated is a liability payable. Payable how much? 150. Is that I will be very clear for you. This is payable. How much they have paid? How much they have paid?
165.
They have paid 165. Is it?
More.
In this process, what is under provision or over provision?
Over.
Over provision.
It is under provision or over provision?
Over.
Over provision.
How it is over provision?
No, doctor, it is under provision.
How it is over provision? Tell me.
Yeah, because they're supposed to pay
Over provision because he
150.
paid it more.
Huh? Yes, Hussein.
Pay more than provision. Guys, it's over provision.
How much we made a provision?
150.
How much they have paid?
165.
165.
Means have you provided more or provided less?
Provided more.
Provide less.
Provide how much you made a provision?
150.
See, you estimated
Okay. Under provision, yeah.
you estimated 150, but you are paying 165. Your estimated is
Yes.
less or more?
Less.
Is it? You see, this is what I know. I know this is every time every student will have this situation. It's not a. It's good for us to make it clear. Is it right? You are making a provision. See, that's what it says. Is it right? You are making a provision. You estimated it. This is for the year 2007.
Yeah.
Is it? This is for the, you have estimated 150, you have paid how much? You have paid 165. Okay, you have paid 165. Means you have estimated less. When you have estimated less, it is what? It is a under provision. How much is the under provision? 15,000
15,
difference.
yeah.
Then you are making both sides same. Are you clear about this?
Yes, doctor.
Now, during 2008, okay, during 2000, don't get surprised. It is normal for every time. Every student will have this. Normal. Now, this 2008, first you have to make that provision. It is a closing balance. Is it right? It will be the difference will be there 15,000. This 15,000 you have to work it out. Okay. This is with respect to what? Last year under provision. Is that last year under provision? And current year, how much you are making a provision? Current year you are
180.
making a provision of 180. Means total provision how much you are making? You have to make 125. First you have to fulfill last year, then you have to think about current year.
Current year, yes.
Okay, this is the simple. You have not paid tax last year, then first you have to pay the last year tax, then you have to pay the current year tax. You think like that, it is very clear to understand. Okay, next,
Yes.
second one. What happening? This is the second case. You can see that this is the second case. What's happening? You have how much you have estimated? You have estimated 150. Is that you have estimated? This is point B. This is point
Yeah.
A. Okay, this is point B. This is point A. Fine. You have made 2007. How much is there? 150. But how much you have? This is the provision. Okay, this is the provision. You have made a provision of 150. But how much you have paid? You have paid 140.
40.
You have paid less. Still 10,000
Yes.
is there in your balance. Credit balance is there. 10,000. Is it right? 10,000 is there in the balance. This 10,000. Fine. Now what happens? You have to for the current year. How much is there? 180. You are estimating 180. Still, how much is the balance is there? 10,000. Is right?
Ten.
Still, the balance is there 10,000. Means what happens when you have the still of balance of 10,000? Definitely, you have made a over provision. Is it? You have made a over provision. You will provide less during the current year. Okay? Means every time You are doing what? You are doing a reconciliation. Isn't it? Every time you are doing a reconciliation. You make what? You will compare. Isn't it? Always. See, as simple as that. If you have any credit balance, definitely any debit balance. Any debit balance means you have to
Pay.
you have to pay it, is it? You have to
Yeah.
pay. That first we will clear the old balance, then we will think about the new balance.
Yeah.
Is it? This will help you in cash flow. Okay, this will help you in cash flow. This is the first part. Is it? This is the first part. What is the second part? Second part talks about deferred tax. Little bit. Any doubt, you stop me. I am telling you very clearly. This is part of your examination. 1, 2 to 4 marks will be there on this. It is very simple. The estimated, it is not current tax. It is a future tax consequences. Is it? In the financial statements of the current and previous periods. Which you are going to pay future, what will you will pay future. You are estimating. You are estimating what you will pay in future if the situation arises. Is it? If the situation arises. From where this situation will come? Of allocating for tax charges to the appropriate relevant accounting period. Okay, you are doing for 2024. You will not take tax which is related to 2025 and 26. We will take only that is relevant to the current period, pertaining to the current period. That's what it says. That the key to deferred tax lies is the difference between two profit figures. Is that two different? That's the key element. Okay. The accounting profit is which is the figure before tax shown in the profit and loss account and reported to the shareholders. What is this is called as a accounting profit. Profit before tax. Okay, profit before tax. What is the taxable, which is the figure for profit calculated tax computation on which taxation authorities base their two calculations. Is it right? We use a concept of a tax base. Is it right? On what we are calculating the taxes? Is it right? See, taxation people have that profit, taxable profit. It is also tax base. Accounting profit before tax. Only thing we have to understand is the tax base. Is it? Now, when you do the thing, there is a difference between accounting and taxable profit. There is a permanent difference, there will be a temporary difference. There will be a permanent difference, there will be a temporary difference. Now, read this one. Even I am reading, you have to read. Not only read, you have to remember. The reason that deferred tax should be recognized is that profit for tax purpose is likely to differ. There will be a difference. Is it like that accounting profit financial statement? The current tax expenses may not correspond to accounting profit. Yeah, there will be underestimation and overestimation will be there. What is the permanent difference? Arises, for example, an expense in the statement of profit is disallowed for tax purpose. Is it right? See, an expense, you have made it as a any expense, okay? Any extra expenses will be, I assume traveling will be there. Is it traveling? You have paid 500. What will happen? The profits will be decreased by 500. Okay, the profits is decreasing for 500. The tax will also decrease proportionately. Assume 10% tax. Is it a 10% tax? 10%, what will happen? Your tax will be reduced by how much? Your tax will be reduced by 50. Subsequently, they will not allow this as a taxable, as a exemption. They will say that no, it is taxable. If that is the case, you have to pay 50. Again, I'm saying the expense in the statement of profit is disallowed for tax purpose. Means it is not exempted. It is taxable. Entertaining expenses and the tax expense increase as a result. You are talking in terms of entertaining. Maybe you have done in taxation, is it right? In taxation you have done what are the exempted, what are non-exempted. The same concept is there. Is that in accounting you will deduct, in taxation they will not deduct. Then there will be a permanent difference. What is the temporary difference? We are not concerned, very simple, we are not that much concerned about permanent difference. We are concerned about temporary difference. It arises when item is allowed for both tax and accounting purpose, but in different accounting periods. Understand point? In different accounting periods, 2024, 2025, it is allowed. Is it right? It is allowed. But it is allowing, you have paid in 2024, but that exemption will apply in 2025. Is that you have paid in it is allowed in 2024, but you paid in a different accounting period. Okay? But for example, a tax relief for capital expenditure is given at a faster rate than accounting depreciation. They say that accounting depreciation is 20%, taxation depreciation will be different. If you remember taxation, is it right? You have return down allowances. Is that return down allowances will be there. Some lifetime will be there. Is it right? You have very simple. I don't want to make this. Some return down allowances will be there. Is that it happens in one accounting period, but it is going to be charged in a different accounting period. The current tax expense will be lower in the earlier years, and then it will be based on the accounting profit. In later years, the tax charges will be higher. Is it? In the initial, why there is a temporary difference? Okay, why there is a temporary difference? What happens? You are starting your own company. Okay, you are starting your own business. They say that you are starting your own business. They say that okay, first 3 years you will have tax exempted. Is that you will have tax exempted, or you will have a lesser tax. You have to pay tax on 10%. You have to take tax on the profits only. This is what it says. But subsequently, what will happen? Your profits are increasing. You have to pay a higher amount of tax. You have to pay a higher amount. It's not like that the revenue will increase only exactly after 31st December. Okay, only exactly after 31st December. Is that the revenue will increase before 31st December. Then what will happen? You are incurring your revenue in 1 year and you are paying the tax in another year. You are incurring a revenue in 1 year, you pay tax in the another year. If that is the case, it is called as a temporary difference. Is it? Temporary difference is the difference between the carrying amount of the asset or liability in the statement position and a tax base. We have to calculate temporary difference whenever on this topic question is given. Okay, slowly it will understand till we are going by step, and by the time we reach that last exercise we will have very clear things. Examples: certain amount of expenditure that are taxed on cash rather than on accruals. Example provisions. Either you are making estimations, is it right? If you have paid or you have received, then only the tax will be charged. Okay, then only the tax will be charged. If it is accrual, next year expenses, income will be next year it will be taxed. It will not be taxed current year. Is that very simple? Is that certain types of income expenditure that are taxed on cash rather than accruals. Accruals means you have incurred now, but you will pay next year. Is that you have incurred now, you have paid accrual concept. The difference between a non-current asset accounting depreciation and the tax allowances, tax depreciation given, this is the most common practical example of temporary difference. In taxation, you have done tax allowances. Is that in taxation you have done tax allowances? Is that what is the most common? And I can say this is the only one which will be tested. The accounting depreciation and tax depreciation. Okay, the accounting depreciation and the tax depreciation. Reasons for recognizing. So for your examination, non-current assets, see what they have told you this also. For in examination, non-current assets are most likely source of temporary difference, but you may see other examples. Reasons for recognizing the accrual concept requires its recognition. They are giving different points, okay? They are giving different points. Deferred tax is the liability or asset. Eventually that will be settled in future. The overstatement of profits by failing to allow for deferred tax liability could be lead what will happen? You will be over optimistic dividend payments based on overstated profits. Is that you are over optimistic, you are overstating the profits, automatically the dividends will be, tax will be less, that profits available for dividends will be more. Distortion, is that earning, it will always affect earnings per taxes. Why it is affecting earning profit, per earning per share? Because earning per share, what is the formula? Profit after taxes divided by number of shares. This all comes with respect to profit after taxes. Both important indicators of performance. So shareholders may mislead. Shareholders may. We should see if you miscalculate the taxation, the next two things. What are the next two things? It will affect the dividend. It will affect the earning per share, because both needs with respect to the profit after taxes, the amount available for dividend shareholders. Okay. What it says, what is the fundamental principle of IAS 2? The entity should recognize deferred tax liability or asset whenever the recovery or settlement of the amount, whenever you are going to make the future tax payments. They will be, what happens? They will be as simple as that, they will be plus or minus. Okay. It will be sometimes it will be higher or sometimes it will be a smaller. We have to reconcile it and you have to settle the difference. That's all. Deferred tax liabilities are calculated by multiplying the temporary difference by the applicable tax rate. This is the basis what they are asking us. Okay, in FR examination you have to calculate the temporary difference. The difference between what is the carrying amount and what is the tax base. carrying amount as per the financial statement, tax base as per the tax applicable for that transaction. Is that you will have the carrying amount, and this is the process. Fine. Now, if the amount in deferred tax during the year that will need to be accounted, if it is increase in deferred tax liability, is that here what's happening? Liability is increasing, credited. Is it? Liability is increasing, debited. What happen? Expenses will also increases. If what happen here, the liability is decreasing. Here the liability is decreasing. Your expenses will also decreases. Depending on the type of asset or type of transactions, either we will show it in OCI or we are going to show in expenses. Is that? General entry is very important. Only general entry, okay? You have to focus on general entries. A deferred tax liability is recognized for all temporary differences. Now keep it in point where we have done temporary difference. Is that temporary difference is what? Temporary difference is this one. The difference between the carrying amount and the tax base. What is the tax base? What is the tax base where we have done where it is there? Is it taxable profits? Okay. What is the tax base? Based on the taxable profits. A taxable temporary difference is fine. The liability is calculated and provided in full. No discounting on the liability. Is it? No discounting on the liability. Is it? What they say, they are talking about, they are just giving you some more explanation. A deferred tax is recognized for all deductible temporary difference. A deductible temporary difference is when the tax base of an asset, tax base assets exceeds the carrying amount, or tax base of the liability is less than the carrying amount. Just keep it in mind. When we are doing this, I will give reference to this. Okay. However, an amount recognized as a deferred tax asset may be restricted. They say that a deferred tax shall be recognized for all differences to the extent it is probable that taxable profit will be available against fine. Means whatever the I will read once again. A deferred tax asset shall be recognized for all deductible differences to the extent that it is probable that the taxable profit will be available against which the deductible temporary difference can be utilized. Means if there any differences is there, temporary difference, first we have to settle down against the temporary difference plus or minus, then we have to carry forward. Means if it is applicable for the current year, any temporary difference we have to settle it down. What is that? Fine. That is what we are working with the deferred tax liability. Neither we should take the next year liability to this year, nor we should carry forward current liability to the next year. The settlement has to be done in the relevant period. Read this once. A company financial statement shows profit of how much? 1,000 each year. Year 1, year 2, year 3. This profit is stated after charging depreciation 200 per annum. Is it? After charging 200 per annum due to purchase of an asset 600 in year 1, which is depreciated 3 years life on a straight line basis. What is the tax allowance they have mentioned? The tax allowance for the asset is 240, 210 and 150. Income tax is charged on how much? Income tax is charged 30% on taxable profits. Is it? Apart from the above depreciation, tax allowances, there is no other difference between the accounting. There are two questions are there. Ignore deferred tax. Prepare statement of profit and loss account. Accounting for deferred tax. Prepare profit and loss account for each year. How much is the accounting profit is there? Accounting profit is how much? 1000.
1000.
Is it right? Shows accounting profit is 1000. Depreciation is how much? 200.
200.
200. Is it right? How much they are providing an allowance? 240. Is
240.
that how much they are providing an allowance? 240. Fine. Next, if based on this, first what you have to do, we have to see how it is going to happen with respect to capital allowance is 240. Is the depreciation is how much? Depreciation is 200. Okay. I'm just writing here. Depreciation is 200. Fine. In some cases, what will happen? Accounting profit is 1000. You have to calculate depreciation is how much? 200. How much they are giving an exemption from us? Tax allowance is how much? Tax allowance is 240. Then we will calculate what is the taxable profits. Fine. Ignore deferred tax. Store the payment of profit and loss extracts. Fine. Now when you are doing the things, point number A. Okay, point number A, profit and loss, profit or loss account extract, profit and loss account. Is it right? For it is a extract. 1, 2 and 3. Is it? How much is the profit before tax? Profit before
1000.
tax is 1000.
1000.
Is it? Profit before tax is how much? 1000. Next, how much is the income tax expense? Income tax
200.
expense. Okay. Income tax expense working 1. Is that income tax expense working 1? Okay. We have to make working here. Working 1. Is that right? Year 1, year 2, year 3. Fine. How much is the accounting profit? Again, we have to go by accounting profit. We have to calculate tax. Okay. We have to calculate how much is the accounting profit? 1000, 1000, 1000. Is that? Now, this accounting profit is after depreciation. Understand point? This is accounting profit is after depreciation. What you have to do? We have to add back depreciation, accounting depreciation. Is that? We have to add back accounting depreciation. Accounting depreciation is how much? Accounting
200.
depreciation is 200, 200, 200. Is it accounting? What is the taxable depreciation? We have to deduct taxable depreciation. Is it right? We have to deduct taxable depreciation. How much is the taxable depreciation? 240, 210
10,
and
150.
150. Is it 240, 210 and 150? How much we will get? 120 minus 1200, 240, 960. 1200 minus 210, it comes to 990. 1200, 1050. Are you clear about this?
Yes.
Yes, Hussein and Sumaya. This is called as taxable profit. Understand? First, you have to add accounting profit depreciation, accounting depreciation minus taxable depreciation. Okay? Taxable depreciation. Now, tax at the rate of how much? Tax at the rate of
30.
30%. How much you will get?
288.
288. Is it? How much you will get? 288. And second one?
297.
To next one?
315.
Next. This is where we are doing, okay? 288, 88, 288, 297 and 315. Two 1712 307 546 586. Is it okay?
685.
685. Is it okay? Are you clear about this?
Yes, sir.
Fine? Now. Okay. Now, coming back to this, is it? Now, what they are doing, they are asking us to do with respect to statement of profit or loss. Okay, extract. The second one, okay, the second one, extract. Now they are saying, how much is the profit before tax? Profit before tax is how much? 1, 2, 3 is 1000s, 1000s, 1000s and 1000s. Okay? Now, how much is the income tax expense?
712.
How much is the income tax expense?
712. 73. Oh, 600.
How much is the income tax expense? At the rate of how much? 30%. Is it right? At the rate of how much? 30%. Is it right?
Yeah.
Is it? At the rate of how much? 30%. We don't have any issue as such. Is it right? We don't have any issue. Here we don't have anything. 300, 300 and 300. Okay? 300, 300 and 300. How much we'll get? 700, 700 and 700. Is it right? In the first
Yeah.
case, see the thing. In the first case, they are asking only one thing: prepare profit and loss account. Okay. In the second case, is it right? In the second case, what they are asking? They are asking prepare for profit or loss, and they are asking a statement of financial position. When they ask statement of financial position, definitely it about deferred tax. Is it right? If there is a deferred tax, what will happen? We should know what is the current liability, what is the non-current liability. Is that what is the current liability and what is the non-current liability? Is that what is the current liability and what is the non-current liability? Now, The income tax, we have done this. Is it at working one? Is it at income in working one? What we have done in working one, we have done related to the tax at the rate of 30%. Is it right? Income tax at the rate of 30%. Fine. It will be same. Okay, it will be same. It is not going to make. But even if it is same, I will make it. I will make it for you. It is there. This is step one. Okay, this is step one. What we have to do? We should know. Step two. Is that very quickly? 1, 2, 3. Is it 1, 2, 3? Same thing I am doing. Okay, same thing I am doing. We are not doing anything different. Is it right? You have a accounting profit. You have a accounting profit 1000, 1000 and 1000. Okay, 1000. Now add depreciation. Is it right? Accounting depreciation 200, 200 and 200 minus tax depreciation, tax allowance on depreciation. How much is there? 240, 210. Is it a 240, 210 and 150? How much we will have? Why I am writing is you should not get confused that from where we have done. Is that 960, 990 and 10500 tax at the rate of 30%. Is that how much is there? 280, 280, 288, 297 and 315. Is it 288, 297 and 2? Now, is it right? Now, what we are doing, we have to calculate temp. Is it right? This is what we have done. Now, they are asking us, keep it in mind, what they are asking us, go back to the previous case and they say that, where is this? Is it right? We have to calculate what? We have to calculate the temporary difference. Okay, we have to calculate the temporary difference. What is the temporary difference? Temporary difference is nothing but the carrying amount minus tax base. Is a carrying amount minus tax base. And is that what is the tax base? We have to, is that what is the tax base where it is there? Where it is, where you have written tax base. Deferred tax, taxation authority. Somewhere it has been given now. Where is tax base? Here. Temporary difference are difference between the carrying amount of asset and liability in the statement and tax base. An asset or liability is tax base. See, the assets and liability tax base is the amount attributed to that asset and liability for tax purpose. Is that assets and liability for tax purpose? Little bit careful here when you are doing this. Okay, when you are doing this, little bit careful here. 1 minute. Step 3. Okay, text step 3 is a temporary difference. Okay, now what is the temporary difference? Carrying amount minus tax base. Okay, carrying amount minus tax base. 1, 2, 3. How much is the carrying amount? What is the carrying amount? What is the value of the asset? Asset value minus depreciation. 600 minus 200. Is it 600 minus 200? 400 minus 200. Are you understanding this? Are you understanding this? Yes or no?
Yes, doctor.
Are you Hussein, are you understanding this?
Yeah.
Mazin,
Yes, doctor.
see the things. Is it right?
Yeah.
600 is the total value depreciation first year, year 1. Is it? What is the carrying amount? Carrying amount is 400. Second year, 400 minus 200 depreciation, year 2. Carrying amount is how much? 200.
100.
Is it right? Year 3, 200 minus 200. This is year 3. Carrying amount is how much? 0. Okay? Carrying amount is 0. Now, coming to the second case, what is the tax base? Is it? How much is the amount? 600. Now you have to deduct the taxable allowances granted to the asset. Okay, how much they have given taxable allowance? It is 240. How much you will get? You will get 360. Is it? Second one, 360 minus 210. 360 minus 210. It comes to how much? It comes to 150. Third year, 150 minus 150. It comes to how much? 0. First one we will take from the accounting perspective. The second one we will take from the tax perspective. Definitely there will be some difference. How much is the difference? Here the difference
40.
is 40. Here the difference is 50. Here the
50.
difference is 60.
0.
This is called as temporary difference. On this temporary difference, is it right? On this temporary difference, we will calculate tax. This is deferred tax, is it right? This is deferred tax. How much is the deferred? At the rate of 30%. What is the tax rate? 30%. 30% of 40, 12. 30% of 50 is 15, and this is 0. Is it? Now, we will see what happens. We will say whether it has been increased, whether it has been decreased. Is it? As per accounting, how much is there? As per the accounting, we have 240. Is it right? Now, what is the difference here? It increased how much? It increased 12. Is that? It increased how much? Is it increased? 15 minus 12. It has increased by how much? It has increased by 3. By the time you will reach, is it right? By the time you will reach the year 3, definitely you will pay all the tax. Is it right? You will pay all the tax. Is it right? The tax will be how much? 0. Is it? See the thing. Again I am saying, is it? First you will calculate carrying amount. Then you will calculate the tax base. Carrying amount as per the accounting depreciation. Tax base as per the tax allowances. Whatever the temporary difference, we will get the temporary difference. Temporary difference at the tax rate. 12, the amount will increase to 12. You will pay 12. Second year, what will happen? It is increasing by 15. You have paid 12. Now you have to pay 3. The difference. On the temporary difference you will pay. Now 3. By the time you will reach the year 3, definitely the life is for 3 years, you will not pay anything. Is that? You will not pay anything. Now, what you are doing, you are making a comparison. Okay, you are making, this is step 2, this is step 3. Okay, this is step 2, this is step 3. Now what we are doing, we have to reconcile as per the accounting, how much you are paying tax. 288, 297, 315. Is it right? 288 means when we are doing this, there should not be any difference between an accounting profit or taxable profit. The temporary difference has to be settled down by the time the life of the asset is over. Okay. Now in step 4, is it right? In step 4, we will make a reconciliation. What is the income tax expense we are paying? Is it right? What is the income tax expense? 1, 2 and 3. Okay. Now income tax expense as a income tax expense as per step 2. As per step 2, how much? 288, 297 and 315. Is it? 288, 297 and 315. Okay, this is now as per deferred tax. Is it right? As per deferred tax, step number I can put step number 3. Is it right? As per step, how much increase? 12. How much increase? 3.
15.
How much increase? Minus 50. How much is there? 300, 300 and 300. If you take income tax expense at the rate of 30% on profits, 1000 is the profit and the income tax expense is at the rate of 30%. See that it is 300, 300, 300. If you take accounting, it is 288. If you take only the deferred tax, it is going to be plus or minus. But in the end, there will be a reconciliation of 300 each. Is it? In the expense of 300 each. So this is where we are doing. Now we have done this. How we have to show it in the statement of balance sheet? Is a statement of financial provision. Statement of financial provision, how much you are going to pay the current year and how much you are going to pay deferred tax. Okay, deferred tax is how much, and deferred tax is a non-current liability and current year tax is a current year liability. Fine. First time you are doing, that is the reason you will do step 5. Is it? Step 5. Step 5 talks about statement of financial position. Is that statement of financial position. Is that statement of financial position? In statement of financial position, same thing. 1, 2, 3. Is that 1, 2, 3? How much you are paying? Non-current liabilities, deferred tax. Is it? Non-current liabilities, deferred tax. Non-current liabilities, deferred tax will be from where you are getting? You are getting from here.
Compare.
Is it deferred tax? Here we have written
Yeah.
deferred tax.
Yeah.
Is it right? Here we have written deferred tax at the rate of 30%. Okay. How much is the deferred tax? 12. Is it? How much is the deferred tax? 12. How much is the deferred tax? 15. And how much is the deferred tax? 0. Is it? The deferred tax is 0. Next, current liabilities. Okay. Current liabilities taxation. Is it? I will put this as a step 3. I will put this as a step 2. Is it? I will put it as a step 2. From where we are getting? We are getting this from here. How much you are paying? How much you are paying for the current tax?
288
288.
and 297,
288, 297,
297,
and 3.
315.
Is it clear to you?
Clear but lengthy.
We cannot reduce the steps. Okay, where we have
Yeah.
wasted time, where we have taken time, we have done this repeatedly. That's all.
Repeated. Yeah.
Okay, we have done. If you see, if we have not done this, then we have saved from 10 or 15 minutes. Okay, if you have not done that, then we have said. But if I have not done that, if I tell you that no, you have to do it straight away without that, definitely you will get confused. Is it right? This is the step 1, this is the step 2, this is the step 3. Fine? Or is it okay?
Yes, sir. Yeah.
Can I stop? Or
Yes,
continue?
doctor. It's all right.
Better.
If you
Huh?
Better to stop because we need to reverse this question.